you are to accept some combination for that level. So we should now proceed with the question. We had seen the 4 combinations that we are meant to accept. So we were to get the coefficient of variation. We were to get the coefficient of variation. So after calculating the expected return, the next item we should compute is now the standard deviation for the portfolio. We only compute the standard deviation for the accepted projects. So let us now compute the standard deviation for the portfolio. We need to come up with the standard deviation for the portfolio. Standard deviation for the portfolio, it will be the weighted average. It will be the weighted average. The standard deviation for the portfolio will simply be the weighted average. So we start with the first combination. We start off with the first combination. We start the first combination that we accepted. Which was the first combination that we accepted? Project 2 and project 3. So you want to compute the standard deviation of that portfolio. So when you combine project 2 and project 3, you remember the initial cost for project 2? The initial cost for project 2 was how much? It was 4 million. So you take 4 million, divide by the total, which was 10 million. Then we multiply by the standard deviation for project 2. Are you able to see the standard deviation for project 2? It is given as 9. It is given as 9. Then after that, we go to the other one, project 3. Project 3 is 6 million. You also divide by 10 millions. Then we multiply by the standard deviation of project 3. Standard deviation for project 3 is what value? 15. You can see the 15? Yeah. So now add them together to give us the standard deviation of that combination. Give us the standard deviation for that combination. It's coming to each figure. 12.6. So it will give you 12.6. That's now the first combination that we accepted. We also compute the second combination that we accepted. Which was the second combination that we had accepted? Projects 2 and 4. So we also compute for project 2 and also project 4. So the standard deviation for this portfolio, project 2, we know it is 4 million divided by 10 million. So what do you have there as the standard deviation? It is 9, isn't it? Yes. Yeah. So we go to project 4, which is 6 millions, which is 6 millions, also divided by 10 millions. Then what is there as the standard deviation? So the question has given you 13. So we combine them in that order. We combine them in that order. Which is meant to give us which value? 11.4. Then the next combination that we accepted was which project and which project? Project 3 and the money market. So we also compute for project 3 and the money market. We also compute for project 3 and the money market. So the standard deviation for that portfolio. So for project 3, the amount is 6 millions. divide by 10 millions. Then standard deviation for project 3 is 15. So if that is the case, the money market was meant to take how much? 4 millions. You also divide by 10 millions. You also divide by 10 millions. Then what is the standard deviation for the money market? The standard deviation for the money market is 5. We now also come up with the standard deviation of that combination. Then finally, which combination? Project 4 and the money market. We also check now project 4 and the money market. We now also confirm for project 4 and the money market. So when it comes to project 4 and the money market, the standard deviation of that portfolio, it is meant to be. So project 4, it is 6 millions divided by 10 million. So that standard deviation was 13. Yes. Yeah. Then the money market was also to take the 4 million, also divide by 10 million. So this one we multiply by 5. So that is now meant to give us the standard deviation of the combinations that we have accepted. So we have calculated the 4 of them. Yeah, so we have the 4 of them. Now we get the coefficient of variation. The mean variance is the same as the coefficient of variation. So we now come up with what should be the coefficient of variation. We now got the coefficient of variation. So when it comes to the coefficient of variation, it is supposed to be the standard deviation of the portfolio divided by expected return of the portfolio. When you want to compute the coefficient of variation, it is simply the standard deviation divided by the expected return. So we shall be computing for each combination that we have calculated. We compute for each combination, then we shall be able to rank them. So we start with the first combination that we have just calculated. So the first combination was project 2 and yeah, so we get the coefficient of variation of project 2 and project 3. So confirm the standard deviation of that combination that is calculated. Confirm for me the standard deviation. Sorry, it was 12.6. Then also confirm what was the expected return of that combination. Sorry, 27.2. Yeah, that one we calculated yesterday. Just confirm the expected return of that portfolio combination. So it is giving us, you can round it off into 3 decimal places because some of them may be too correlated. So you can round them off into 3 decimal places. So when it is 3 decimal places, it will give us which here? 0.463. And then we now also compute the coefficient of variation of the next combination that we accepted. The next one was project what and project what? So project 2 and project 4. So what was the standard deviation for project 2 and project 4? We calculated today. 11.4. Then what was the expected return of that combination? We calculated 30.8. Then the other combination that we accepted was project what and the money market. So project 3 and the money market. We also computed for project 3 and the money market. So that combination of project 3 and the money market, standard deviation is 11.
Yes.
Exactly 11.
Yes.
Yeah. Then we divide by expected return for that combination we calculated yesterday. It was 24. Then the last one will be the coefficient operation of project 4 and money market. Project 4 and the money market. So standard deviation for that combination is what value? 9.8. So what was the expected returns? 27.6. Yeah, so you can rank them. Sometimes they may ask you to do the ranking. So let me know here, really must bear with figure. 0.377. 0. And here the next one is which figure? 5.458. Now here I'm showing 0.354. 55. So if you are to rank, the one with the lowest is ranked as number 1. You remember the notes we noted that coefficient of variation, it indicates the risk per unit of return. The lower the coefficient of variation, the less risky the project is. So the one with the highest, the lowest will be ranked as number 1. So here is number 1. Then here it will number 2. Then this one will be number 3. So that one is number 4. If they ask you to do the ranking, the one with the lowest coefficient of variation must be number 1, because it is the risk per unit of return. So we now pick the one with the lowest. We finally pick the one with the lowest. So now we can conclude that we can now make a conclusion that the best project combination is where coefficient of variation is minimum. The best project combination is where the coefficient of variation is minimum. Therefore, select project 4 and the money market. We select project 4 and the money market. So that was part A of the question. That was now the part A of the question, where they were asking you to use mean variance rule so that you come up with the optimal project combination. So mean variance is the same as the coefficient of variation. Mean variance will be the same as the coefficient of variation. And the coefficient of variation is simply the relative measure of the risk, which indicates the risk per unit of return. So we had written that, I'm only just emphasizing on the same. We had written that coefficient of variation is a relative measure and it indicates the risk per unit of return. So the lower the coefficient of variation, the less risky the project is. So in your ranking, you pick the one with the lowest. So the lowest we have seen to be project 4 and the money market. So that is part A of the question. Let us now go to part B. We now go to part B. When it comes to part B, you are asked, when it comes to part B, you are able to say that determine the beta and required rate of return for the portfolio. Then use CAPM model to evaluate how you should invest the 10 million. So we need to compute the beta factor. So computing the beta factor, we require the issue to do it. What should be the beta factor for each of the for each of the 4 projects and the money market? So the first thing we shall do is to get the beta factor for each project and also the one for the money market. Then once we have done that, we now get the weighted beta factor. So one of the formulas I had given you, the beta factor of, let's say, project X. The beta factor of, let's say, project X. It is supposed to be given by correlation coefficient between project X and the market multiplied by the standard. So let me say the beta factor of your portfolio, not the project. If you want to get the beta factor of, let me just use the project. The beta factor of project of, let's say, security X. It will be given by correlation coefficient between security X and the market multiplied by the standard deviation of security X. We divide by the standard deviation for the market. This is one of the formulas that you are using, how to get the beta factor. But now we should be computing the beta factor for each project. Now, if I want to get the beta factor of project 1, if I want to get the beta factor for project 1, I get correlation coefficient between project 1 and the market. So I want you to confirm in the question. They gave you correlation coefficient of return over the 2 years are as follows. So are you able to see the one between project 1 and the market portfolio? Are you able to see the correlation coefficient between the project? The correlation coefficient between the project and the market portfolio. So are you able to see the one for project 1 and the market portfolio? Yeah, so the beta factor for project 1 and the market portfolio, it is 0.68. So you take 0.68 multiplied by the standard deviation of that project 1. Are you able to see the standard deviation for project 1? It is given as, then we need to divide by the standard deviation for the market. So standard deviation of the market, are you able to see at the end of the question that over the 2-year period, risk-free rate is estimated to be what percent? 16%. And the market portfolio return is 27. And the variance of the return on the market has been given as 100%. So the standard deviation for the market gets the square root of the 100. Is that fair? 10. So this one will be 10. So that will give you the beta factor for project 1. It will give us the beta factor for project 1. It will be the beta factor for project 1. So after project 1, you also compute the beta factor of project 2. We also get the beta factor for project 2. We take the correlation coefficient between project 2 and the market portfolio. Are you able to see the beta factor of project 2 and the market portfolio? It is 0.65. Then the standard deviation of project 2. The standard deviation for project 2 is given as 9. So the standard deviation for the market remains 10 like that. It will be able to remain 10 at that point. Then you will also compute the beta factor for project 3. We shall also be coming up with the beta factor for project 3. What is the correlation coefficient between project 3 and the market portfolio? 0.75. Then we multiply by the standard deviation of that project 3. Standard deviation is 15. Also divide by 10. Then we also compute the beta factor of project 4. We also compute the beta factor for project 4. Correlation coefficient between project 4 and the money market, the market portfolio. It was given as 0.88. Then what are you given as? The standard deviation of project 4. So to repair our 13, so 10 remain the same. So the last one, we also compute the beta factor of the money market. We also compute the beta factor for the money market. So check the correlation coefficient between money market and the market portfolio. Are you able to see the one between the money market and the market portfolio? It is 0. What? Yeah, so you take 0.4 multiplied by the standard deviation of the money market. Are you able to see the standard deviation for the money market? Money market standard deviation is given as 5. Then also the standard deviation for the market will still remain 10. So those are now the beta factor of each project. That will be the beta factor for each project. So we want to apply CAPM. We want to apply CAPM to see which project are we going to accept in that area. So what we can do, what we can now finally do at that point, what we can finally do at that level, so what we can finally do is that we shall be able to have the portfolio. We can be able to have the portfolio. We can be able to have the portfolio. So after the portfolio, we compute also the beta factor of the portfolio. The beta for the portfolio will be the weighted average. The weighted average. Then after you have calculated the beta for the portfolio, we also get the return of the portfolio according to CAPM, where it will be risk-free rate, then expected return for the market minus risk-free rate, then the beta factor of the portfolio. Then once you have done that, now you take expected return of the portfolio minus the return of the portfolio. So we shall be picking the combination with the highest excess returns, because the question wants you to use CAPM. They want you to apply CAPM. So when we apply CAPM, we shall be computing the return of the portfolio on the basis of that. So those expected return for the portfolio, we had already calculated them. We had already computed those values. So we start with the first combination that we accepted. It was project 2 and it was project 2 and 3. So we get the one for project 2 and project 3. So to get the beta for that portfolio. So you remember the proportions. Project 2 was it 4 million? The amount invested in project 4. Was it 4 million? Yeah, so it was 4 million divided by the total, which is 10 million. So give me the beta factor for project 2 that you have just calculated. 0 points. Sorry? Like that. Then project 3, it is 6 million amount invested. Also divided by 10 million. So what do we have as the beta factor for project 3? 1.125. So now when you compute that, it should be able to give us which figure. Not around its value. 0 point. Like that. So now we compute the return for the portfolio. We now compute the return for the portfolio. So risk-free rate is given. Are you able to see in the last paragraph? Risk-free rate is what percentage? 16. Then expected return for the market is 27. Also minus 16. So the beta factor, it is 0.909 like that. So we come up with that value for the expected return for the portfolio. So risk rate is given in the last paragraph. The next market portfolio return is also given in the last paragraph. When you round off to 2 decimal places, will be exactly 26 into 2 decimal places. Umepata 25 point. Okay, so you can have it as 26. You can have it as 26. So now we come at this point. You see expected return for the portfolio. If we check when we started the question, we calculated that. Mnakumbuka how to determine the project to accept. We calculated those expected returns. For that combination 2 and 3, it was how much? 27.2. So now minus 26. Get the value for that. So that you get the value. So that is for combination 2 and 3. For the combination for projects 2 and 3. So we go to the second combination that we accepted. Remember the second combination that we accepted? It was project 2 and project 2 and 4. So also this one, we get the beta for the portfolio. So beta for the portfolio, it is 4 million divided by 10 million multiplied by 0.585. So for project 4, it is also meant to be 6 millions divided by 10 million. So what was the beta factor for project 4? 1.1. So also get that back. Zero point 9. So you also come at this point 16 plus 27 minus 16, then 0.92. And now check where we meet the expected return for that. $30.8. Then also subtract 26.12. The next one was switch combination. Projects. Project 3 and so project 3 was 6 million. Divided by 10 million. So the beta factor for project 3 1.125. So 1.125. Then now we also add this 4 millions divided by 10 million. So what was the beta factor for the money market? 0.2. Sorry. 0. I lost. 0.7. 55. So that this one so this one will give us this time. 24.3. So tukikuja hapa ile tulikuwa ngapi? So hiyo itakuwa negative. Then the last one was project 4 and the money market. The last combination was project 4 and the money market. So project 4 and the money market. So project 4 was also 6 millions divided by 10. So the beta factor was 1.144. Then we add now the one for the money market. So the one for the money market will be 4 million divided by 10 million, or someone by 0.2. $0.76. And pia hapo inakuwa 16. So that one has given us which figure? 24 points. Then what was the expected return of that portfolio? Sorry? 27.6. So now you compare all of them. Which one has the highest excess returns? So we want now to select the one with the highest excess returns. Which combination has the highest difference? Project 2 and 4. So we can now make a conclusion that the optimal project combination, is where we have the highest excess returns. Is where we have the highest excess returns. Is where we have the highest excess returns. Therefore, select a combination of project 2 and project 4. Select a combination of project 2 and project 4. We select a combination of project 2 and project 4. So that is now on that question. I decided to do it because sometimes they will go there and pick one question from that pilot paper. Now, the term, so they may pick it. Nowadays, they make so many mistakes. So last time, when I was auditing a pilot, I mean, what happened? Why did they cancel your exams for audit? It was not the same as the one for the pilots. It was the same paper that was there for the pilots. So that was the red flag. The paper is already out and people are doing it. So the paper they had given you for the pilot was the same paper they finally gave you for the exam. So that was an issue. So I will do all those questions in the pilot paper. Just once we get on that topic, we should be looking at them. Then we see how they differ. So now that is all about that element of portfolio theory and the CAPM. So if you check now the one for the last sitting, if you check the one for December 2021, the real exam, I don't know whether I showed you question 2, part A, Roman letter 2. You can see question 2, the one for the real exam for the last sitting, December 2021. Question number 2, part A, Roman letter 2. You can see the Roman letter 2, where they were asking to highlight 4 weaknesses of using what? CAPM. So the weaknesses are the same as the assumptions. I gave you the assumptions or limitations of CAPM. The weaknesses or limitation are the same as the assumptions. Check where we started CAPM. I gave you around 7 assumptions. So those assumptions are the same as the limitations or weaknesses. Mukonazo. Yeah, your pair assumptions of CAPM. One of them, it was a single factor model. That is a weakness or a limitation on itself. So those the weaknesses they were asking you at that point are the same as the limitations or the weaknesses. Assumptions are the same as limitations or the weaknesses. So now that will be the conclusion between the portfolio theory and the PEM. So I want us now to start a new topic. We shall now start a new topic. So the new topic should be financing decisions. Our new topic will now be financing decisions. Our new topic should now be financing decisions. Will be financing decisions. Our new topic will be financing decisions. So we shall be picking each decision separately, then we discuss. So under the financing decisions, I will start with the first one. So the first one, under the financing decisions, we can have a subtopic there as point of indifference. Under the financing decision, we can have a subtopic as point of indifference. We can have point of indifference. Under the financing decision, we can start with a subtopic as point of indifference, the point of indifference. So we can note something brief on that. We can summarize that this is a financing decision. This is a financing decision. It is a financing decision where earning per share, where the earnings per share and earnings before interest and tax, where the earning per share and the earnings before interest and tax, and the earnings before interest and tax of all the available financing options, of all the available financing options, of all the available financing options are equal. Of all the available financing options are equal. Then we continue by noting that i.e. So this is just a demonstration, i.e. So earning per share for option 1 will be the same as earning per share for option 2. Also, earnings before interest and tax for option 1 will be the same as earnings before interest and tax for option 2. So earning per share for option 1 is the same as earning per share for option 2. Also, earnings before interest and tax for option 1 will be the same as earnings before interest and tax for option 2. Therefore, the investor is unable. Therefore, the investor is unable to select. The investor is unable to select a given financing option. The investor is unable to select a given financing option. Then another paragraph. The investor is unable to select a given financing option. Another paragraph, we can note that the earning per share for various financing options, the earning per share for the various financing options, the earning per share for the various financing options will be expressed as follows. The earning per share for the various financing options will be expressed as follows. Will be expressed as follows. So number one will be all equity financed. All equity financed firm. All equity financed firm. Number one will be all equity financed firm. All equity financed firm. So if it is all equity financed, earning per share will be given by earnings before interest and tax. Then 1 minus the tax rate. We divide by number of the ordinary shares. So to get the earning per share, it will be earnings before interest and tax in the bracket of 1 minus the tax rate divided by the number of the ordinary shares. The number 2 will be equity and debt. Equity and debt financed firm. Equity and debt financed firm. So if that is the case, earning per share will be given by earnings before interest and tax. We subtract interest, then 1 minus the tax rate. Then we divide by number of the ordinary shares. The number of the ordinary shares. We divide by the number of the ordinary shares. Then finally, number 3, it can also be equity. It can also be equity, debt, and preference shares finance. Preference shares finance. Finance. It can also be equity, debt, and preference shares financed. So earning per share for that option will be the same as earnings before interest and tax. We subtract interest, then 1 minus the corporate tax. Then we minus the preference dividends. Preference dividends. Then we shall be able to divide by number of the ordinary shares. Number of the ordinary shares. Number of the ordinary shares. So we shall take a short break. When we come back, we go direct to the questions in relation to that. So we can start with a question for May 2019. Question number 1, part B. May 2019. There is a question number 1, part B. May 2019, question 1, part B. You check on page 26. When you go to page 26, there is a question for May 2019, question number 1, part B. Question 1, part B. So you check May 2019, question number 1, part B. So that question 1, part B is about manufacturing limited is considering to raise 10 million shillings. To raise 10 million shillings. On page 26, there is a question for May 2019, question 1, part B. Question 1, part B. So they are considering to raise an extra 10 million. To raise an extra 10 million in order to finance an expansion program. In order to finance an expansion program. So you are given, the company's current capital structure is given as follows. So there is ordinary share capital. There is ordinary share capital where the total value for that is 60 million. The bar value is 20. They have also given you reserves. Then they were also able to provide you with the 14% debenture capital. The 14% debenture capital, also 10% preference share capital, 10% preference share capital. So at that point, you can see there is equity, debt, and preference shares finance. That capital structure, it has equity in the name of ordinary shares and reserves. There is also 14% debenture making it debt. There is also preference share capital. So that firm, it is equity, debt, and preference shares financed. That firm, it has both equity, debt, and preference shares. So additional information, note number 1. The company is considering raising the funds using 2 alternative financing options, namely option 1, to raise all the funds through the issue of the new ordinary shares at par. Then number 2, to raise a half of the funds through the issue of the new ordinary shares at par, and the balance through the issue of the 12% debentures at par. Then now when you go to the next page, they gave you note number 2. The corporate tax rate is given as 30%. So required Roman letter 1 earning per share and earnings before interest and tax at the point of indifference in the company's earnings for each financing option. Then number 2, earning per share at the point of indifference. So we shall start, equate the two, then we come up with the earnings before interest and tax. Then after that, also the earning per share in order to come up with the point of indifference. So when you check through the capital structure, they have stated that there is equity, there is preference shares, and also there is debentures. So that form, it is equity, debt, and preference shares finance. So we start by analyzing option 1. So option one, it is equity. The form is equity, debt, and preference shares finance. Equity, debt, and preference shares finance. Equity, debt, and preference shares finance. So that is now our option 1. The form is equity, debt, and preference shares finance, whereby earning per share for option 1 will be the same as earnings before interest and tax. You subtract interest, then 1 minus the corporate tax. Then you subtract the preference dividends, we minus the preference dividends. Then you will be required to divide by number of the ordinary shares. We divide by number of the ordinary shares. So in the question is we compute the interest. We compute now the interest. We compute the interest. So interest, when it comes to the interest, we check in the capital structure. Check in the current capital structure. So in the current capital structure, are you able to see 14% debenture capital? The total amount is how much? Yeah, so get 14% of 20 million. Interest will be the 14% of 20 million. 14% of 20 million. Sorry. 2.8. So we get 2.8 million. Then we also need to compute a preference dividends. We also need to come up with preference dividends. So for the preference dividends, you can see the 10% preference share capital, total amount is how much? 10 million. So get 10% of the 10 million. There are 3 zeros at the top. We get 10% of the 10 million. That will give us how much? It will give you 1 million. The next item will be number of the ordinary shares. The next item should be number of ordinary shares. To come up with the number of the ordinary shares, we start with the one in the capital structure. You can see the ordinary share capital in brackets. The bar value is 20. Then that total amount is how much? 50. So you take 50 millions, divide by the bar value, which is 20. But check under also option 1. Also check under option 1 in the question. They stated that under option 1, to raise all the funds, to the issue of what? New ordinary shares. So in the first paragraph, how much are we supposed to raise? We want to raise the 10 million. So under option 1, to raise the 10 million, we are again issuing new ordinary shares at par. When you check in the capital structure, you can see the bar value. It is how much? 20. So we also add the amount to raise is 10 million, and each share will be issued at 20. So that now gives us total number of the ordinary shares under option 1. That now will give you total number of the ordinary shares under option 1. Total number of the ordinary shares under option 1. So there will be how many ordinary shares? Sorry? Exactly 3 million. Now we go to our equation. We now go to our equation. Earning per share for option 1 should be equal. So earnings before interest and tax, we don't know that figure. It is one of the items we are looking for. So we just put it like that. Then we subtract interest. Interest, it is 2.8 million. Interest is 2.8 million. Like that. Then in brackets, 1 minus the corporate tax. Corporate tax in the note number 2, they had given you what percent? So 30% is the same as 0.3. So it is 1 minus 0.3. Then you subtract the preference dividends, which is 1 million. Then divide by the number of the ordinary shares, which are 3 million. So I want us to open the brackets. I want us to open the brackets to simplify. So the brackets, 1 minus 0.3, the same as what? Yeah, so you take earnings before interest and tax, multiply by 0.7. Also take 2.8 multiply by 0.7. So it will now be the same as 0.7 earnings before interest and tax. Then you also minus 2.8 million multiplied by 0.7. 1.96. So 1.96 million, we also minus 1 million. Then we divide by 3 million. So finally, we simplify the equation. It will be 0.7 earnings before interest and tax. Then minus 1.96 million minus 1 million. Minus 1.6 million minus 1 million will be which figure? Minus and minus. It has 2 points. Yeah, because minus minus, they is continue like that. So you divide by 3 million. So that's now finally our equation. That's now our final equation for that option 1. So we need now to create the one also for option 2. So this is our equation for option 1. Now we come up with the one for option 2. Then we equate them together because at the point of indifference, earning per share for the 2 options will be the same. Earnings before interest and tax for the 2 options will also be the same. So let us now also analyze option 2. Let us also analyze what is there for option 2. We also analyze option 2. We also analyze option 2. We should also be able to analyze option 2. When it comes to option 2, so when it comes to option 2, the firm is still equity. It is still equity, debt, and preferred shares. preference shares financed. Preference shares. So the farm, it is still equity, debt, and preference shares financed. So remember the original capital structure. It had ordinary shares, it had debentures, it had preference shares. So that farm, it is still equity, debt, and preference shares financed, whereby earning per share for that option 2 will still be earnings before interest and tax. Subtract interest. Then 1 minus the tax. We minus the preference. We minus the preference dividends. We divide by number of the ordinary shares. Divide by the number of the ordinary shares. So now we compute interest. We compute interest. Interest starts with the one in the capital structure. We start with the one in the capital structure. We remember the one in the capital structure, 14% of 20 million. So it was 14% of 20 million. But I want you to check under option 2. I want you to check under option 2. So when you go to option 2, to raise a half of the funds through the issue of the new ordinary shares at par, and the balance through the issue of what percent? New 12% debentures at par. So when you check in the first paragraph, the amount to raise was 10 million. So ordinary share is taking a half. So a half of the 10 million will be 5 million. So ordinary share has taken 5 million. The remaining balance is also 5 million. So for the 5 million of the debenture, they will issue the debentures at what interest rate? 12%. So now we also add 12% of the 5 million. 12% of the 5 millions. When you add them, that now will be able to give you the total interest under option 2. You start with the one which is in the capital structure plus the one of the new funds you want to raise. You add them together, they will give you total interest. So here in Akunya, how much? 3.4 minutes. Then the preference dividends have not been affected. The preference dividends have not been affected. So it will still remain what was initially there. It will just remain what was initially there. So remember 10% of what? 10% of the 10 millions. So 10% of the 10 millions should be which figure? It was 1 million. Now we also compute number of the ordinary shares. Now also compute the number of the ordinary shares. Currently in the capital structure, it was 50 millions. The par value was 20. Then a half of the amount to raise. Now your option 2. A half of the amount to raise comparing ordinary share is 5 million. But they are also being issued at what price? So the par value is 20 shillings. So we add them together to give you the total number of the ordinary shares. We add them together to give us the total number of the ordinary shares. So how many ordinary shares are we getting at that point? 2.75. So now we go to our equation. Our equation should be earning per share of option 2 should be equal to earnings before interest and tax. So now interest is 3.4 millions. 3.4 millions, then 1 minus 0.3. You also subtract 1 million, divide by 2.75 millions. So when you open the brackets, it will be 0.7 earnings before interest and tax. Then 3.4 millions multiplied by 0.7. So 3.4 millions multiplied by 0.7. 2.38. 2.38. Also minus 1 million. Then divide by 2.75. So finally, it will be 0.7 earnings before interest and tax. So minus 2.38 minus 1 should give us a total of 3.1. So 3.38 divided by 2.75. So those are now our two equations. Those are now our two equations. So that now we say that at the point of indifference. So that now we say that at the point of indifference. So at the point of indifference, earning per share for option 1 will be the same as earning per share for option 2. So for option 1, it is 0.7 earnings before interest and tax. 2 minus 2.96 divided by 3 millions should be equal to the one for option 2 is what we have just prepared down here. It is meant to be 0.7 earnings before interest and tax. 3 minus 3.38 millions. Then we divide by 2.75 millions. So we cross multiply. We should be able to cross multiply so that we make earnings before interest and tax to be the subject. So when we cross multiply, it will be the same as 2.75 million. So I'm cross multiplying by that. So in the bracket of 0.7, earnings before interest and tax, we minus 2.69, should be equal to. So this will be 3 millions in the brackets of 0.7, earnings before interest and tax, minus 3.38. So I want you to open the brackets, then you collect the like terms. Then make the earnings before interest and tax to be the subject. So open the brackets and make earnings before interest and tax to be the subject. Let's see what value are we going to come up with. So, what are we coming up as? Earnings before interest and tax. Tumepata ngapi hiyo? 11.42 9 like that. Yeah, so online I can see you are also getting the same figure. So that was meant to be the Roman letter 1. That was meant to be Roman letter 1, where they were asking you to compute. Earnings before interest and tax at the point of indifference. So now we go to the Roman letter 2, where you are to compute earnings per share at the point of indifference. So earnings per share for option 1. We go to the equation the way it is. Where there is earnings before interest and tax, we put there that figure. So to get the earning per share. So for option 1, it will be 0.7 multiplied by earnings before interest and tax, which is now 11.429. Like that. Then you subtract interest, which is 2.96 millions. Then you divide by 3 millions. So that will be for option 1. That will be for option 1. Then we do the same for option 2. We do the same for option 2. So it will also be 0.7 multiplied by 11.429. Then minus 3.38 millions. Then we divide by 2.75 millions. So the two figures should be the same. The earning per share for option 1 and option 2 should be the same. Nakuja how much per share? 1 point. Yeah, so all of them are the same. So 1, 6, 8, also. So that is now your Roman letter 2. That was meant to be the Roman letter 2. So a similar question on that. There is a similar question on that area. So this one should be, it should be May 2018. May 2018. Question number 3, part C. May 2018. Question number 3, part C, page 39. When you check on page 39, there's a question number 3, part C for May 2018. May 2018. On page 39, there is a question number 3, part C. There is a question number 3, part C. There is a question number 3, part C. So question number 3, part C. Question number 3, part C. You are given information that Nangina Limited is considering acquiring Query Limited. So Nangina Limited is contemplating financing of the acquisition of Query Limited using any of the following options. Using any of the following options. So option 1, an ordinary share for the ordinary share exchange. An ordinary share for the ordinary share exchange. So for that, it is that under the terms of acquisition, Nangina Limited will offer one of its ordinary share for every 2 shares in Query Limited. So that option 1 is all equity finance. Because there was no other initial information. They are simply telling us that an ordinary share for the ordinary share exchange. So option 1 will be all equity financed. Option 1 will be all equity financed. Then option 2, it is ordinary shares for what? Debentures. That obviously now becomes equity and debt finance. That will be equity and debt finance. Where they are saying that Nangina Limited expects to offer 2 units of 10% debentures for every how many ordinary shares? 100 ordinary shares in Query Limited. Each unit of the debenture has a bar value of 100 shillings each. They summarized financial information relating to the 2 companies for the year ended 30th November 2017 was as follows. So they have given you Nangina Limited and the Query Limited. Profit after tax, the number of the shares, earning per share, market price per share, price earning ratio, and also the corporate tax rate of 30%. So now required, determine the combined operating profit of the 2 firms and the post-acquisition earnings per share at the point of indifference in the firm's earnings under financing option 1 and option 2. Under the financing option 1 and option 2. So we shall start by analyzing option 1. We shall start first by analyzing option 1. So option 1, it is all equity finance. Option 1 is meant to be all equity financed. So option 1 will be all equity financed. So option 1, it is all equity financed. So under option 1, it is all equity financed. When it is all equity financed, earning per share of that option 1 should be given by, earnings before interest and tax in the brackets of 1 minus the tax rate. We divide by number of the ordinary shares. We divide by the number of the ordinary shares. So the only item we should now compute should be the number of the ordinary shares. So first get the shares to be issued. Shares to be issued. We need to come up with shares to be issued. So shares to be issued, when you check under option 1, under the terms of acquisition, Nangina will offer one of its ordinary share. So 1 share will be exchanged to how many ordinary shares of Query Limited? 2 ordinary shares. Will be 2 shares. 2 shares. So 1 share of Nangina is equivalent to 2 shares of Query. So check under the income statement. Are you able to see on the next page under the income statement? Query Limited has how many ordinary shares? The number of the shares for Query. It has 6 million ordinary shares. So if it has 6 million ordinary shares, so how many shares will be issued? Because one share will enable them to acquire 2 shares here. Now there are 6 million shares. So how many shares will be issued now to acquire? Very limited. So you cross multiply and get those shares. You cross multiply, then you get those particular shares to be issued. So when you cross multiply, it will be the same as 6 million shares multiplied by 1 divided by 2. So that will be equivalent to 3 million shares. So now we can come up with what should be the earning per share. So that we now so total shares now after that. Total shares will now be the total shares. So Nangina has how many shares currently? No income statement. It has 20. And now it adds the 3 millions it is issuing to raise the new farm. So that total will now be 23 million ordinary shares. So earning per share now for option 1 would it be earnings before interest and tax. The corporate tax rate is 30%. Then you divide by 23 million ordinary shares. So finally, the equation should be 0.7 earnings before interest and tax divided by 3 millions. Divide by the 23 million. So that is now our equation for option 1. That will be now our equation for option 1. So now we go to option 2. Now also check what should be there for option 2. Let us now check what is meant to be there for option 2. So option 2, when it comes to option 2, so option 2, it is equity and debt financed, equity and debt financed. It is meant to be equity and debt finance fund. So when it is equity and debt financed, earning per share for option 2 will be the same as earnings before interest and tax. We subtract interest, then 1 minus the tax rate, divide by number of the ordinary shares, divided by the number of the ordinary shares. So now we need the number of debentures to be issued. So we start by looking for number of the debentures to be issued. Number of debentures to be issued. So number of the debentures to be issued, when you check through the question, they say that under option 2, Nangina expects to offer 2 units of the debentures for every how many ordinary shares? 100. So 2 debentures is equivalent to 100 ordinary shares. So 2 debentures is equivalent to 100 ordinary shares. But we know Query had how many ordinary shares? It had 6 million ordinary. So how many debentures were they able to issue? How many debentures were they able to issue in order to acquire now with limited. So you cross multiply. It will be the same as 6 million multiplied by 2 divided by 1. So we come up with the number of the debentures at that level. So it's 100 and what? So there will be 120,000 debentures. 120,000 debentures. So we want now to get the interest on that. We want to get so interest will be one debenture is worth how much? When we check in that paragraph, yeah, the debenture has a bar value of 100. So take those debentures, multiplied by 100 per debenture. The interest rate was given as what percent? It is 10%. Yeah, so get 10% of that total. So that now will be our interest. That should be able to give you the value for the interest. It should be able to give us the value for the interest. 1.2 million. Then the number of the ordinary shares are now meant to be just 20 million. They have not issued ordinary. They have only issued what? Debentures. So check under Nangina. Currently, it has how many shares? 20 million. So they will just remain 20 million. The number of the ordinary shares will just remain 20 million. Number of ordinary shares will simply be 20 million. So now we go to that equation. We go to now our equation. We check under our equation. So we check under the equation. So when it comes now to the equation, earning per share for option 2 will be earnings before interest and tax. We subtract interest, which is 1.2 million. Then 1 minus 0.3. Then we divide by what? 20 million. So when you open the brackets, yeah.
Second option is
you have a company, you want to acquire another company. Before you started your company, you acquired shares. Yeah. Then you can move hiyo ingine ulikuwa pesa kwa bank. So what will be the final in your capital structure? Well, the debenture is borrowing from the bank. Yeah, you borrowed how much? You ulichukua 220,000 to multiply now 100. We borrowed how much? 1.2. Na interest ilikuwa ngapi? Ndio katupea interest ya how much? So the amount borrowed was 120,000 multiplied by 100. It was 12 million. Yeah. So when you borrow 20 million, kununua hiyo company. So your final capital structure, it will have your initial ordinary shares, which is 20 million. But sasa hiyo ingine ni debt. Yeah. So the other part is the debt. That's why now your capital structure, it has equity and debt. Currently, you have the ordinary shares, then you have borrowed in order to acquire another company. So your capital structure has two components. the ordinary shareholders and now the amount borrowed. That's why it becomes equity and debt financed farm. We look at the farm in general, not the option. Now, under that option, what is the position of the farm in general? It has ordinary shares, but it has also borrowed now. So when now you open the brackets, it will be the same as what? 0.7 earnings before interest and tax minus what?
0.84.
0.84 millions. Divide by what? 20 millions. So now we equate the two equations. Now you equate the two equations. So the two equations should be that earning per share for option 1 should be equal to earning per share for option 2. So option 1, it was 0.7 earnings before interest and tax divided by 23 millions. It should be equal to 0.7 earnings before interest and tax minus 0.84 millions. Then divide by 20 millions. So we cross multiply. We make earnings before interest and tax to be the subject. We cross multiply. So when you cross multiply, what should be your earnings before interest and tax? Sorry? 9.2. Exactly 9.2 millions. So that now your earning per share for option 1 will be 0.7 multiplied by 9.2 millions. Divided by 23 millions. Also, earning per share for option 2 will be 0.7 multiplied by 9.2 millions. Then you subtract 0.84 millions. You divide by 20. So they should give you the same figure. They should be able to give you the same earning per share. So what should be your earning per share now? 0.28. So when we meet, I will do one more question where they will require you to draw a graph. Then we conclude on that element. So we can stop there.